Hello investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Roblox. So Roblox just saw its shares exploding higher a few days ago, and it was a stock that everyone was saying there was a COVID trade and that it would fizzle out its revenue growth rates. It apparently has not. Its revenue growth rates have been very strong, so we're going to discuss that. We're going to talk about how to think about the revenue drivers here. We're going to talk about its valuation, and so hopefully this will be helpful to you. Okay, so one of the things that I wanted to highlight is that my previous article about Roblox, I had said that it's difficult to become a bull of the stock while being asked to pay 15 times next year's revenues. For a company that's coming up against difficult comparisons last year and its revenue growth rates are so uncertain, it's basically difficult to get behind a stock. Well, lo and behold, the stock is up 40%, more than that, in fact, since I wrote the article. And so when I'm wrong, I'm very happy to say that I'm wrong, but ultimately the most important thing is that when you're right, you haven't really learned anything. But when you're wrong, you have to go back to the drawing board, think this through again, and see what you can learn out of it. So that's what I'm trying to do here. So one of the things I want to highlight is what's been already reported amply, that its top line was up 100%, more than 102% year over year. So when everything was said and done, when everyone was worried about the tough comps that it would come up against last year's same period, they just demolished all the bears, right? So one of the things I wanted to say is that what Roblox does is basically allowing people to exist or to be or to play in a 3D environment, and it's built by developers. Okay, that's the key here. So Roblox doesn't make the environment, they just give the tools to developers to create the environment. So that's a key point that we'll come to in a minute. But before we get into that, so obviously DAOs were up, that was great, and engagement is also up. Pricing power, or average bookings per daily user, but pricing essentially was flat. It was negative 2% year over year. It's not a big deal. Okay, so flat pricing and a jump in user engagement and user growth. So that's good, right? The problem that I've always had with this, that I've had over the last period with Roblox, is that the bookings are trending lower. Bookings are a leading indicator of where revenues will come. So if bookings start to come down, at some point their ability to recognize that revenue is going to be an issue. So the gap between in Q1, when it was the bookings were up 161% year over year, and going into Q2 it dropped to 35% year over year, and into Q3 it's 28%. So the gap between Q2 and Q3 is slightly smaller, but this is going to be an issue. But for now, investors are not really too concerned about that. For now, everyone's on the bandwagon, and it's buy, hold, set and forget, whatever you want to call it. Now it's just nothing matters at the moment. But at some point, this will start to kind of reappear, and this will be an issue as well. So one of the things I wanted to highlight is that Roblox has a free cash flow margin of 26%, okay? Pardon me, sorry, no, it's 33%. So they make 510 million in revenues, and they had 130 million of free cash flow. Very strong, right? And wait, that figure's wrong. They had 170 million of free cash flow. But the problem is that when Roblox recognizes, takes in their bookings, they get deferred revenue upfront. So people give them cash upfront, which adds a substantial amount to the free cash flow. Now, the problem is that a large portion of that has to go back out as a cost of deferred revenues. So what it means in practice is that even though the revenue growth rates are exploding higher, there's a proportional increase in the variable cost to developers exchange. So their ability to really drive strong, profitable gap is going to be very, very difficult for them. I don't see a way that they could really ultimately be a strong free cash flow generating machine. And you can see here that year over year the free cash flow was only up 7%. So for revenue was up triple digits, for the free cash flow to only be up 7% really speaks to the heart of the bearish thesis. So I previously had an issue, the company being priced at 15 times forward sales. Now at 20 times forward sales, I have even more issue, because I understand the appeal of investing in high growth companies. I get that. But ultimately you start to think yourself, do profits matter, and will this business ever be meaningfully gap profitable? I'm not talking about them adding back the stock-based compensation and all the other pesky costs being added back to EBITDA, but I'm just trying to think myself, can I see a way that this business can be meaningfully profitable? And I'm not really sure I could. So I'm not opposed to paying 20 times forward sales per se. I just, if it makes sense, and I'm not sure 100% that it does make sense. But ultimately, if you want to find out what kind of stocks I'm excited about, don't forget to check out my marketplace. It's called Deep Value Returns. I help you become a better investor. You can check out what other people have said in my 5-star reviews. And yeah, I hope to see you soon. Thanks for listening.